Well, it's been a quiet week, but we still see volatility and we have a long weekend coming up. But we just came off the Jackson Hole Symposium. So I wanted to bring in Jim Welsh of Macro Tides to talk about what he saw with the knee buckling Fed Chair Powell. No, I did. I just threw that in there. I mean,
No opinion being expressed there whatsoever. No, I think, again, last week we talked on Thursday before the
yeah.
Friday. And, my take was I didn't think he was going to give any hint that a rate cut is coming. That said, he did say may allow for a change in policy. So that word may is what really set the equity market afire. Interestingly enough, the bond market didn't really react the same way. The dollar weakened, gold had some legs to it. So a lot pinned on that word may, which from my perspective, Blake, and we probably talked about this, over the last couple of weeks prior to Jackson Hole, the odds makers were saying, yeah, it's like 85% the Fed's going to cut in September.
Yeah.
So was this really, newsworthy? We may cut. He also said some other.
I should mention that it's still at 85% as of this morning when I was looking at
Right.
probabilities
I mean,
earlier.
I think it dipped to the high 60s, so you had a little bit of a pullback. But, he also emphasized, I think, was saying, hey, given the state of the economy, we can be patient. Every meeting, everybody's going to make up their mind at each of these meetings. So to me, what kind of was lost in translation a little bit was, or people made the assumption that, oh, okay, he's talking about a cut, which given the way they do forward guidance, him using that word may is the Fed's forward guidance of saying, hey, now the door is really open to a cut. But I think the markets also thought, well, this is probably going to be the beginning of a series of cuts. And I think some of the things that Powell subsequently said kind of just said, whoa, hold your horses. Now, I just wanted to point out here that the picture on the left next to
Is
the
from
quote,
like 3 decades ago.
no, it was just from right before the election last year. And then
Are
the
you sure
picture on the
about that?
right,
Are you sure about that? Are
I'm
you?
positive because I think President Trump has been so brutal that he has aged Chair Powell rather significantly. And this is my evidence right here. Like one picture from a year ago, the picture on the right from a week ago. All right. But here's that statement, with policy in restrictive territory, the baseline outlook and the shifting balance of risk may warrant adjusting our policy stance. All right. Now, again, because he used the word may, that is Fed speak for, okay, now I am leaning toward lowering the funds rate. After Jackson Hole, there were two or three other Fed voting members who kind of were like, well, I mean, one of them, the St. Louis Fed, Musselman said, well, this is what we know for real. Inflation is at 3% above the Fed's target, and the labor market might weaken. So I'm in the camp. I'll make up my mind 2, 3 days before the meeting because there's a lot of data coming. You've got the August CPI, August PPI, August employment report on September 5th. And the one that I think may be the deciding determinant is the benchmark revisions, which we'll talk about in a minute, coming on September 9th. But my point is, the way people reacted to me was a little overdone relative to what Powell actually said. And I think we're the FOMC voting members, where there really are, in terms of their mindset about not just September, but what comes after.
Okay, I still think that's a 2 decade old file photo that was used by CNBC. Whatever, Jim, it's okay. All right. Well,
Well, back then he was using the creams, that get rid of wrinkles that, you see advertised. Obviously, I don't use that stuff. And Jay stopped using it, he just stopped using it.
apparently. All right. Well, the next slide, Jim, you brought is about inflation, and inflation is going to be a problem. And the Fed chair, he's referenced it in the FOMC meeting minutes last week. You heard a lot of Fed governors talk about
Yeah.
the risks of inflation, and it may even outweigh employment. So why'd you bring us this table?
Well, just these are 9 different ways to measure inflation by various Federal Reserve districts. And if you average them all for July 25th, it's 3.13%. And we've seen CPI, PC, all of these have been moving up. And Powell even, noted that, yeah, we're probably going to see more tariff inflation show up in coming months. He referenced goods inflation. What he didn't talk about was services, the inflation that we're seeing in the ISM report, the CPI report, the PPI report. And that's more meaningful because it relates to, labor costs. They're more intractable. Okay, goods prices go up because of tariffs, then they're going to stop going up. And so it's a pass-through thing. But services is a different animal. So to me, the key thing, I think for me, and I think for some Fed members, Goolsbee actually gave a speech a couple of weeks ago. He mentioned services inflation. And this is the guy who's consistently the most dovish guy on the FOMC. So, watching services is important. My only point is we're likely to get a Fed rate cut in September, even though inflation is comfortably above their target of 2% and it's been creeping higher. So what is it that's got them, I guess, motivated? And maybe the next chart might provide us an answer.
There we go.
This is one of the answers, and I've shown this before. And what I'm doing here is trying to, you hear the Fed say, well, it's, somewhat restrictive. Well, what does that mean? All right. So what I did is came up with kind of a mathematical formula that neutralizes the level of the funds rate. Because you can see in 1981, the funds rate was over 19%. But look at where the CPI was. So what I did is subtract the CPI from the funds rate divided by how much it's above the Fed funds rate is above the CPI. And you convert it to a percentage. Now we can compare all these crazy different levels in the funds rate. And what you can see in August of last year, remember, the Fed then subsequently cut 50 basis in September and another 25 in October and November, I believe. And the percent above the CPI was 38.7. Well, right now it's 38.2. So because look at the CPI has come down from where it was last August, 329 to 270. Even if it goes up a little bit, this point is still valid. And so from their rationale of saying, all right, well, we have room to cut. Well, this explains that policy's modestly restrictive. If they cut the funds rate by 25 basis points, it's not going to make a huge difference. And after they do that, policy is going to be still modestly restrictive. And that has been the argument, if you will, that Governor Waller and Bowman has been making, that tariff inflation is going to be a pass-through, and the monetary policy is restrictive. We can afford to cut rates once and then stand back and take a look and see what subsequently happens as more data comes in. But this is the logic behind his position. I think some of the other members who have been reluctant to cut recognize that, okay, there's room to cut a tiny little bit, but they want to wait to see more data.
Okay. Well, speaking of data, this next week is going to be a big data for jobs, and so everybody's going to be talking about the jobs
Yeah.
market. So you brought this slide here.
Well, this is the revision that's coming on September 9th, but you're 100% right. The next employment report is going to be a big deal. Now, the revisions that happen, or the biggest revisions for May and June, I think it was 250,000 or some number like that. The biggest 2-month revision going back, other than when you're in a recession, going back to 1968. What happens routinely, and we talked about this a few weeks ago, when the Fed sends out these surveys, they're in the mail. And so the reality is only about 60% of the surveys get back in time for any month's employment report. Then more surveys come in afterwards. So it's the perfect breeding ground for revisions. So I think there's a chance that the revisions for May and June might be reduced a little bit. 73,000 was the number in July. And you have schools going back, government workers happening. So there's a lot of adjustments that take place in the month of August, which again invites future revisions. So my only point is that employment number next week may not be quite as bad. The unemployment rate was 4.2, up from 4.1 the last month. So if that holds steady, that might give some of those people who want to be patient, like, okay, this is the right course. The revisions, Goldman Sachs estimates are going to be between 500 and 900,000. That comes out a week before the Fed meeting. And I think this is going to be the tiebreaker and will be the thing that convinces those who want to be patient and wait, Blake, to say, you know what, we can cut by 25 basis points. Policy is still going to be restrictive. And these revisions suggest that the labor market isn't as strong as we thought. So we're taking out an insurance policy by cutting by 25 basis points. I think that's the compromise that will happen at the September meeting between those who wanted to cut in July and those who didn't will go along with a cut in September. And I think this report will probably be the deciding factor.
So, Jim, I know you don't have a slide here about it, but how does the immigration picture factor into our jobs numbers as well? I mean, we have obviously less immigrants coming in the United States now, especially up by your southern border, down by
Yep.
your southern border. So, how's that going to affect the jobs market in the months ahead?
Well, that's going to weigh on job growth because you have fewer people entering. As you might remember, back in 2023, and I think it was April of 23 to early 24, the unemployment rate went from 3.4 to 4.2 very quickly. And we talked about when that was happening, and I was talking about, hey, immigration is these people are coming into the country, they're looking for work, they're not finding it right away, and that's why the unemployment was going up. So the unemployment rate wasn't going up because people were getting laid off, and you saw, which would represent a decline in the demand for labor. Instead, you had this big supply increase, which is why the unemployment rate went up. We're seeing that being unwound, to your point. And so with, fewer people, people being deported and so forth, that ironically will probably help keep the unemployment rate lower because
Yeah.
you're going to have fewer people looking for work that aren't gaining a job.
Yeah.
So again, the key metric for me is watching layoff announcements because that will tell us, in a sense, the immigration stuff has been represented noise. And over the last year or two, there really hasn't been a meaningful increase in layoffs. Therefore, if and when we start to see an increase in layoffs, and it'll be kind of hinted at when you start seeing unemployment claims really move above 250,000. So those are the things the Fed is going to watch. But this revision will create a pall over, gee, just how strong they thought the employment labor market was. Now, the thing I will mention, I think I mentioned it last week, basically the birth death model creates jobs that aren't there. And then the revisions say, hey, guess what? Those jobs weren't there. But the economy has been chugging along without those phantom jobs. So to me, there's a tendency to overreact when you see these revisions and say, oh my God, and that'll probably happen again on September 9th if the revisions come out the way Goldman estimates they will. But my point is, wait a second. The economy's been doing what it's doing, even though those jobs weren't there. So let's not, hit the panic button and
Right.
overreact. And again, I think some of the people who are reluctant to cut the funds rate will go along with it, but that might be one of their arguments is that the economy still seems to be in decent shape. So we don't need to give it too much. And that then gets down to the messaging that'll happen after the September 17th meeting and people giving speeches and interviews where some of them are going to say, well, one meeting at a time and we'll take the data and so forth. So anyway, I think this is the grand setup to what'll happen at the September 17th meeting.
All right. Well, the next slide you brought is regarding Fed Chair Cook, and this looks like looks like we've got some Fed seats that are going to be really, how should you say, um, stacked, if you will, for the GOP, right?
Yeah, well, that is what people are concerned about. A, because you have Waller and Bowman, who were nominated by President Trump. Oh, lo and behold, those are the two people who dissented at the July meeting who wanted to lower rates. So they must be in his pocket. And what's going to happen is Jerome Powell, uh, he's gone in May, so they get to nominate another person. And if they can get rid, and or Kugler resigned a month ago, so
Right.
Stephen Marin is on. So right now, Trump appointees are three. Once Powell leaves, that'll be four, and therefore he'll have a majority no matter what, probably by next May.
Do
And
you
if
think he's
Cook,
going to leave? Do you think he's going to leave? He doesn't
I,
have
you
to.
know, you know, I think there's two things. A, I think Jay Powell believes in the integrity of the Fed, the importance of its independence, and therefore I think there's a reasonable chance that he will stick around. So I'm glad you brought that up because I'm writing the September macro tides, and that kind of what my conclusion is that this guy's been committed to this organization, doing what he believes is the right thing, or at least making best effort, and he may stick around. Plus, he gets the added bonus is that his actual term doesn't end until 2028. So he can hang around for another 2 years and irritate President Trump.
Right. Well, that's the unintended consequence that Donald Trump might be getting at this stage in the game is, you have a Jerome Powell. It's like, look, I know I'm not Fed chair, but I think I'm going to stick around for a little bit longer.
Yeah, I mean, I think that, I think people have made the assumption that, boy, with all the grief, I bet he can't wait to get out of there. You know what? I think this guy's commitment to the Federal Reserve, and in his mind, I think you bring up a good point. I think it's a 50-50 call. And I think that very well he may choose to stick around because he does believe and wants to see inflation get back to that 2% target. So even though he may not be Fed chair, part of his legacy and maybe in his mind is I stuck around until so I could help contribute and guide policy toward that achievement. The other,
Maybe it's just like that violinist on the deck of the Titanic. I'm going down with
uh,
it. Going down with it.
yeah, I'm going to be here and I'm going to go out in grace and style. The other thing that I find objectionable is the assumption that some people make that Waller and Bowman have no integrity. Therefore, and their justification for that position is, well, look at man, they wanted to cut rates in July just like Trump wanted them to. Well, if you really take a time and read what Waller has said and laid out, he's talking about a modest cut and then waiting. In addition, President Trump has said, oh, I want 300 basis points. Gee, that's so out there. So I find it objectionable that there's people so willing to think that just because somebody got nominated by Trump, that they're going to carry his water. And I just don't believe, I think these people have more integrity. I think their commitment is pretty complete. And therefore, I think those kind of ideas are not truthful. The other thing is the Fed board, and this is the other thing that's been raised, like, oh my God, the Fed board can replace all the Fed presidents. They're up every 5 years. So on February 28th of next year, Blake, the board could theoretically say all the Fed presidents are gone and then replace them with Trump people. I just find that absurd. That's just not going to happen. But to me, it comes down to perception. You and I can talk about this and maybe come to an agreement that, all right, Trump is going to try to exert influence, but I'm not sure how that he won't be limited. But if the perception is that, hey, Trump is going to influence the Fed, they're going to cut rates even though the inflation rate's at 3%. Well, do you want to buy Treasury paper in that environment? Well, maybe some people institutionally will not want to be as aggressive. The other
Yeah.
thing, and I pointed this out in the last couple of months, and I think we've shown charts. Look at what's happening in the Japanese 30-year yield. It's the highest ever. German bond yields are up. UK yields are up. And we're talking like the highest in 10 to 14 years. in terms of where these yields are. So what's happening in the U.S. Treasury market, it's global. And there's going to be more debt sales from all these different countries. And the US is going to have to compete for those global capital flows, and losing a little bit of confidence in the Fed because people perceive that Trump is going to push the Fed to do things that will lead to more inflation. That's completely counterproductive.
Well, we have a great salesman that makes literally is on a road show every single day with Treasury Secretary Besson. I think that guy doesn't go a day without being in the public eye. So,
Yeah.
what's this mean for the dollar? Because you've been looking for a dollar to bounce and it's been struggling. But
Well, as I noted the last 2, 3 weeks, once the dollar rallied and then overlapped that 98, 95 high,
Mhm.
that says, okay, that's either an ABC or it's a 1-2-1-2, and the dollar needed to start to rally strongly in a wave three. Well, it hasn't done that. All right. So that kind of says, well, maybe it is an ABC. Now I can say that, okay, despite Trump and the Cook issue and Jackson Hole's speech and all the rest of that stuff, the dollar hasn't fallen apart. At the same time, to me, it increases the odds, which I've also noted as we've talked, that there is the risk that the dollar is going to go down and make a lower low below 96.37. That bounce to 100.25 was basically a wave four, and you got one more drop. I would say the probabilities are tilting in the favor of the dollar going down one more time to a new low. It doesn't change the bigger picture, which is the dollar's approaching a very important low, but we needed more proof. And when you had that overlap, that kind of undermined that bullish argument in the very short term. And the action over the last week or two has diminished it as well. And I noticed the RSI at 47. Look at the bottom panel.
Yeah.
It's been hovering around 50 for a month. It's a momentum indicator. If it's at 50, it's not telling you anything. you know,
Right.
so to me, it also then allows that the dollar could drop to a lower low. The RSI will drop, make a higher low relative to where it was in April. And, at that point in time, I think one wants to be more aggressive in terms of going long the dollar. But we're not there yet. And the odds have shifted away from in a near-term resolution to the upside to, okay, we got to be patient. There's probably another low coming. And once that low is in place, then I think that I expect that the dollar is going to have a very strong reversal.
Got it. All right. All right. Well, let's take a look at what you got for gold because gold is trying to make its move higher. Like you
Yep,
can see, I'm going to finish your trend line here. It looks like we're trying to get there.
get above that. Yeah. As we've talked, to me, there were two key levels, and in the weekly technical review, it was 3403 and 3207. Because you can see that the gold has been kind of compressing in a more narrow and narrow range. My take was if it gets above 3403, I think it is signaling that wave five to a new high has begun. And so that's my conclusion today is wave five to a new high has begun. I think gold is going to rally above 3,600, might make a run at 3,700. This is wave five. And the metals, both gold and silver, wave fives have a tendency to be very explosive and dynamic in the sense of, saying it's going to 3,600 might be, comfortably conservative.
All
But I
right.
think,
Well,
from where we sit today, I think a move above 3,600 is coming. And if that's correct, we shouldn't take out the most recent low. And I don't have it on the screen there, but I think it was 3305, something like that.
yeah,
Uh,
somewhere right here.
yeah,
Yeah.
that one right in there. Yeah. So we should hold above that.
All right. Well, how about what's that going to do to the 10-year? Because notes, now this is yields.
Yes.
Yields look weak, 10-year notes look strong. So,
Right. So my take for weeks has been first it was we're going below 420, which was the low you saw on the 4.205, which was in what, June? So I thought, okay, we're going below that. When we got to 418, it's like, okay, you can make the case that it has completed the pattern, but my vibe has been, no, I think it wants to go down one more time. As long as it didn't close above 441, and it hasn't. So to me, and two legs being equal, there's the target on the yield of around 407. So my take here is that the yields are going to fall in the near term. But once this move is over, Blake, I think bonds are setting up for a move where yields are going to go up and the 10 years going above 5%. So to me, this is like the last gasp before yields become more dynamic to the upside. And again, bond supply, Trump doing what he's doing, the inflation numbers are going to deteriorate. So I think that's the risk for the bond market. So to me, we're nearing an inflection point in bonds.
All right. Well, you've been talking about the advanced decline line in the S&P. So what are you seeing here that
Okay, the
suggests
advanced
that those
decline
markets
line,
shouldn't hit all-time highs again?
yeah. The AD line has made another new high. And so for me, that has meant in the last month or two is, hey, we could see a 3 to 5% correction, but nothing worse. The decline that we did see was 3.3%. So the fact that the AD line keeps making higher highs is constructive going out. The lower panel shows a 21-day oscillator of net advances and declines. In a really good market, it gets above the red line and or makes higher highs. Well, obviously that's not happening. So to me, this is another cautionary signal near term that a pullback of 3% or so, I think can develop. And, this week is the week going into Labor Day. There's a seasonal upward bias between today and tomorrow. So I think you have to wait for any real pullback until later next week. NVIDIA came out with some great numbers, and my take has been watch how the stock trades. And if it doesn't move higher on good numbers, it's telling us something. And I think the message to me is NVIDIA near term is running out of gas. And I think the semiconductors then are also going to see a pullback. I thought we'd see a pullback to 280 in the semis. It got to 281. I think another pullback to at least that 281 low and potentially below is possible as people just literally take chips off the table, over the next 2 to 3 weeks. So, again,
But can that just equate to just rotation? I mean, you come out of NVIDIA and you go into Procter and Gamble. I mean, I don't know. I'm just
no. I mean, it's a fair point, and it's in part, we're seeing a little bit of that because that's why the AD line keeps making higher highs. That some of these stocks, that are experiencing at least some selling pressure, the overall market isn't. What's happening is some money is flowing out of those stocks into other parts of the market.
yeah.
And that's why the advanced decline line has been making higher highs. So my concern is more just short term in terms of we've gotten a lot of news. Markets perceived it as good news. And I just think there's going to be hesitation going into that employment report. And I really think, Blake, there's a decent chance that the jobs number comes in over 100,000. That will dampen some people's, we'll see the percentage of the Fed going to cut at the September meeting probably drop from, 85 to 78.
Sure. All right. Well, Jim, it's a long weekend for a lot of us that are listening in. For those of us that don't have any travel plans, or even if they do and they want to read your most recent report, what's the best way for them to get a hold of it?
Jim Welsh Macro at Gmail. I'll send you out the recent weekly technical review, and I'm hoping to get the September Macro Tides, which goes into the Lisa Cook thing, artificial intelligence, a little deeper dive on that. So if you want to get that, Jim Welsh Macro at Gmail.
All right, Jim. Well, thank you very much. I hope you have a wonderful Labor Day weekend, and hopefully you get to spend a little bit of time with some of your family that's in the area.
Yep.
And I look forward to catching up with you next week.
Thanks, Blake. Same to you and everyone else. Hey, have a great, safe weekend.
All right. Make sure you give Jim a thumbs up, subscribe to the channel. I'll catch you guys next week. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.